When a venture capitalist invests funds in a startup,
Yeah.
is there a calculated, I guess, risk of error in terms of, them putting money into a startup, and then knowing that a certain percentage of them are probably likely to fail? Is that ever a thing that you consider?
I'd like, to be honest, the actual number doesn't come up in discussion, but it's kind of known that this is, so venture capital on the risk spectrum is like the highest risk investment asset class.
Yeah.
And it goes like venture capital, then like traditional private equity, and then you go into like risky debt and all that kind of stuff, and then equities and like and fixed income, right? So there's like that spectrum. I probably missed so many things there.
No, that's okay.
So, you're right, they do expect a certain loss rate, and at the moment we're investing out of 2 funds, so we just announced our raise of $1 billion Aussie dollar fund.
That.
So that's split across.
Unheard of in Australian
VC,
right?
It's the record, so it's the biggest fund, and it's a great sign for the maturity of the Australian ecosystem. So we were all so proud of that. And where the fund is split into 2 funds. So you have the core fund, which is 300 million, and that's for pre-seed to Series A. And then the follow-on fund, which is 700 million, and that's like Series B plus. And they have different risk profiles. So in the core fund, basically what we want to believe with every investment is that it has the potential to return the whole fund. Whereas the follow-on fund has a different kind of mandate, and it's more about absolute returns. So, you have a lower loss rate. You don't expect, when something's at Series B, you don't expect it to go to zero as often as you do in like pre-seed.
Sure.
But I guess it's kind of like a little bit lower risk return in the follow-on than it is in the seed. But the seed has, in the core fund, but that fund has more of like the power law outcomes embedded into it. So, if you put random numbers on it, like you might expect like 30% to go to zero, like 40 or 50% to kind of return themselves, and then like, the remaining 20% might be power law outcomes and pay off the whole fund.
Welcome back to this episode of the Student Founder Podcast, a community and platform we're building around student entrepreneurship. We bring on expert business individuals, venture capitalists to understand the mentality of working with startups, and of course, student founders and entrepreneurs themselves to put them in the spotlight they deserve in Australia. Australia is full of talent, and we thought that we'd create a platform and educational community we can bring them all together so they can talk about their experiences. I'm your host, Oliver Cucanic, PhD student by day, student founder by night. And this episode is brought to you by Rofi Labs, a software development company that myself and a group of friends helped create out of the University of Melbourne. We offer fast, economical software solutions for startups and also people looking for resources. If this is something you'd be interested in learning more about, reach out to us on LinkedIn. Link will be in the description. Now, we'll get straight into the podcast. Today's guest is an investment associate from BlackBird, a venture capitalist investment firm who invests in every type of technology from software to space, including companies as big as Canva. She has broad expertise ranging from sales, marketing to investing. This includes having worked with companies as large as JP Morgan. Before moving into the startup world as an investor, if you're someone who wants to learn more about raising capital, this is definitely the episode for you, so make sure to tune in because it's going to be a good one. Introducing to you the talented, seemingly jack of all trades, Nicole Marino.
Hi. Good. Thanks so much for having me. This is actually the first time I've ever recorded a podcast.
Wow.
So,
yeah. I mean, it can be a bit intimidating at times, especially with the camera set up. People aren't used to being on the camera, but just trust me, 2 minutes later, you'll forget they're there. So don't worry too much. So I just wanted to touch on that statement I made when introducing you, jack of all trades, because it's kind of an interesting quote, right?
Yeah.
Some of us, forget that sometimes getting broad expertise is actually quite useful. And somewhat being a generalist is useful in some degree. And that quote, I think it was a Shakespearean quote, jack of all trades, but a master of none, is an unfinished quote, right? Like people think that, if I become too general, then that's worse than just focusing on a single thing, right?
Mm-hmm.
But the end of the quote actually is, but better than a master of one, right? So you yourself come from diverse backgrounds. I feel like somewhat of a quintessence when it comes to that quote in itself, because you have such a broad range of experiences from your whole life. So We appreciate you coming on, and it's going to be a good episode, you sharing your perspective with everybody. Now, we'll start off with something really simple, something you'd be very familiar with, which is you yourself being an investment associate. What actually does that mean?
Yeah, so the investment associate role is pretty broad. I think BlackBird wanted to bring on a group of more like junior team members to account for the fact that they were probably struggling to scale themselves as BlackBird grew as a firm. So the objective was to make sure that we were still out in the community and meeting people, and the partners and principals didn't have enough time for that. So they hired 7 of us, and we're across Melbourne, Sydney and Auckland. I guess there's like 3 areas that we focus on. So firstly, it is just getting out into the community and meeting people. So I guess that's where we met Oliver. I think it was at a startup.
Yeah, it was at a startup.
Meetup.
It's interesting. Like we've had so many crossovers throughout the time knowing each other. Like the first time at the startup, like was it like a networking event?
Yeah.
And then recently I just competed in a pitch competition during my PhD, which was actually against your partner, and we both ended up winning. And then I was like, oh, you know Nicole, I know Nicole. And then I was like, you have to force her to come on the podcast now.
I told him about you because I was actually really impressed when I met you. Also with your breadth of knowledge, but just your clarity of thought. So when you were explaining to me sort of the details of your single cell screen on the lung cells, you explained it so well, and I knew nothing about that, but I was able to understand. That's really important, science communication.
Absolutely.
So I definitely remembered you.
Yeah.
So that's the first element. I think the second element is supporting partners and principals on investments internally. So whether that be companies that we already have in the portfolio and we're following on, or new investments that have been introduced to them, so the associate role is generally to do deeper research, due diligence, customer reference calls, and write up the internal memo or the first draft of that, which goes to our investment committee.
Sure.
And then
you're working very directly with the startups themselves, right?
Yeah. And so also, involved with the portfolio companies and building relationships with them, and we've just started shadowing on boards with the partners and principals as well. I guess to help them with that workload and also to learn. It's such a great experience. And then I think finally, and it's not totally required at this level, but if you're interested, you're able to sort of look into new investment areas, which is what we call a river of inquiry at BlackBird. So it's basically just, diving into an area that we might not invest in yet, but building a thesis around it. Or even if we do, it's called thesis-driven investment. So you have a view about the future and how that might evolve, and then you can sort of connect the dots when you meet companies that fit into that thesis. And so, pretty broad and exciting role.
That sounds like a very engaging job. Like, you're not just really focusing on the one monotonous thing. Like some careers are very, focus-driven. It's like, okay, this is your task. Become good at doing this task, and that's kind of your whole life, right? You seem to be very busy doing a lot of different things, talking to different startups, organizing different documents, and traveling a lot as well, which is interesting.
I guess
it's hard to get touch of you.
Just in Australia, it's quite an autonomous role, which I really love. I love the ability to direct my own career and tasks. So if you like that, it's great.
Yeah, sure. So how did you actually start your academic journey, and how did that lead to where you are kind of as an investment associate?
Yeah, so as in what I did at university and how I chose. I was pretty broad at school, so I think, what you said about me being a generalist is more just a product of my personality. So it's just, I'm just so curious, and I always want to learn about everything, and I get bored if I'm just doing one thing. So it just, at school I did, science, math, languages and all that stuff. And it
languages, Spanish.
Yeah, well, I did Japanese at school.
Japanese,
and I had a few mentors, one from science and one from accounting, like an accounting firm. And I was the first in my family to go to university, so I really didn't have much direction from them, and I could have done anything that I wanted, really. So it was about, I was pretty impressionable at that age, and so I met with the scientist, and she was a researcher, I think at CSL actually, because we went to the labs.
Big biotech.
And she was, I think she was a bit downtrodden about life at the time, and was kind of like, oh, don't do this unless you're really passionate about working with mice and writing grants your whole life. And
she's right to some degree.
To some degree, but I think science is much broader than that, and I just didn't realise. But then I met with the accountant, and he was telling us about his swanky life in Hong Kong, and then it sounded so interesting, and that sounds good. So, and I also did one of those like careers tests, and it pretty much said like that I should be like a business manager or like a scientist or an investment banker. So, like, I feel like it kind of knew me. Like, it was one of those things. So I ended up choosing commerce.
Yeah. So you did have an inherent interest in science.
Yes, that was my favorite subject at school.
Yeah. Okay. So favorite subject at school was science.
Yeah.
But found yourself falling more engaged with the concepts in business.
I thought the career opportunities sounded better.
Yeah.
From my like naive perspective.
No, I mean that resonates with me quite a lot because I mean, you know, I'm studying my PhD at the moment in cancer research. Yeah. But again, I'm also somewhat of a person with many interests, right? Yeah. Curious of different industries, including software development and also just business and startups in general, which is why I started this podcast. Why I'm here right now talking to you and engaging in all these different, you know, networking events. So it's interesting that like you can learn so much just by talking to people and engaging with different areas of the world. So yeah, absolutely. So I did commerce, and I went to Melbourne Uni, and what I liked about it was that you could do breadth. So you know, I did my major in finance and economics, but then I could also do a side track of Spanish. So I did 6 levels of that, which was fun. And I actually met all my friends through that side because commerce is just, I don't know, it's, from my perspective, it was a pretty dud degree. Like, you don't really meet anyone unless... Sure. So what do you think, I mean, it's a hard question to answer, but the biggest issue with the degree structure in itself, what do you think it is? Because so many people, they get into commerce, they're like, cool, I want to become, you know, the next... you know, big quintessential expert in business, and then they get in and they're like, oh, we're just doing like historical case studies, and it's just so boring and streamlined.
It's the problem with it, in my view, is that you are told to memorize things and not to understand things, and that's actually a big problem with education in general. I find. Absolutely. And so I did much better in economics than I did in finance for this reason as well, is because economics, especially at the higher level, so when you're in third years, and I did my honours as well, really requires understanding and problem solving.
Absolutely.
So you, for honours, you couldn't memorise anything.
No, I know. I've done honours, Like it's very application based.
Well, I guess if you do a science honours, it's more of a research project. Mine was a research project, but we also had to do 6 subjects. Okay. But they're like, at that point, they're just math subjects. Yeah. So you can't pass a math subject with memorization, right? Sure. But finance is like, they give you a formula sheet and they say, apply these rules. And they tell you that things like the efficient market hypothesis exists and they are right and there's no like reason to question it.
But there's no perfect system, right?
And
they're like guidance tools.
Well, and it's obviously not true that because the efficient market hypothesis basically says that prices reflect all information and that you can't beat the market. But obviously you can, because plenty of people beat the market. Yeah. A lot more people don't beat the market, right? But there are people who do. So that tells me that the theory is wrong in some way. But finance doesn't give you any room to question that. It's just like answer in this very mechanical way. And I found that so frustrating and boring.
Yeah, fair enough.
So ended up doing economics, did honours, and I liked the challenge of it and thought about doing a PhD. Like, kind of went back and forth, and my supervisor said, maybe you should work for a little bit because...
It's the best thing to do.
Yeah.
Honestly.
An economics PhD, if you want to go to the US, is like 5-6 years. Extremely competitive.
It also just needs
depressing.
To be... of course, depressing. There's always a depressive moment in any PhD.
You have to really love it.
Yeah, it has to be something that you can really waver the sacrifices required to accomplish that achievement. Because it is great to get a PhD, but it's not great to get a PhD for the wrong reasons. Yeah. You have to really know what you... Not necessarily what exactly you want to do, but roughly how you're going to use that information in your career or trajectory forward in some way to leverage yourself.
And you have to be deeply passionate about it, which absolutely. I've now realised I'm not with economics. In fact, I'm more passionate about finding all the problems with it than actually following some theory. So it wouldn't have been a good idea.
I mean, you could always do a PhD in looking at the the issues in economic trends. Yeah, disproving things.
Possibly,
right?
You're right. Yeah.
Anyway, so... I mean, you're obviously a very curious mind, very skillful in that because you've got different perspectives and expertise. Did you ever consider during your path to start your own business? Is that ever something that you considered?
Yeah, I kind of go through phases, like pop up with an idea in my head. Usually I do a bit of research and then like, no, it's not worth it. Like I don't I don't really align with the idea of being a founder for founder's sake. I feel like you have to find a problem that you really want to solve, and you're impelled to do it, and that's where the motivation comes from. So I don't feel like I have any problem that I'm uniquely placed to solve, and so for the time being, but of course I thought about it. And I didn't just think about startups. I mean, you could just start a business. Like, there are many ways that you could be personally successful with an Australian business, and I could have done that. Like, I have a background in real estate and sales, so I thought, hey, I could start a real estate agency and have kind of a unique angle.
You'd make a lot of money.
Well, there's not really anyone like me in the industry.
That's
so
true.
I felt like I could have, but then I was like, do I really want to start a real estate agency? I didn't, like, I got bored of my last job. Why would I want to do that as a career? Sure. So I didn't do that. Yeah, well,
I mean, it's not always monetarily driven, right? It has to be passion driven.
Exactly, you're right.
You have to enjoy what you do, otherwise you'll be miserable at the end of the day.
Yeah.
So as I said when I introduced you, there's, this position that you were in where you worked for JP Morgan. Yeah. So what did you actually do there, and how did you land that position?
That was an internship.
Yeah.
So,
which is still good, by the way. That's not like, don't take away from your achievement.
After my, so I took my second year off university. I deferred to go for a sales role, a full-time sales role at this construction company that I'd been working at part-time for 4 years prior. And I did that. That was actually the best learning experience of my career. So not the JP Morgan.
Sales.
Yeah, I mean...
they say, like, if you want to learn about business, learn sales.
I think so, and just how to... I can't really articulate it well, but it was...
Well, it's an intimidating part of a business, right?
It was intimidating. Like, I remember when I got the job, I really pushed for it. Like, this is what I do. I always, like, really push for things. And... then I get into it and I'm really nervous.
Yeah, you're like, I'm like, oh wow, right here.
I didn't expect them to say yes type thing. So, but that's the value of just asking for things and putting yourself in uncomfortable situations.
Absolutely.
But I remember the first time I had an appointment with a customer, I was so nervous and my hands were shaking. Yeah. And she must have thought like I was an idiot. It was so embarrassing. But the important thing to learn from that is that's normal and it's not going to keep happening if you push through, right? Probably even with this, like the first podcast you do, probably
trust me,
nervous.
You'll see it when it comes out. It was probably, it was a good podcast. The content was good, but I was so nervous. Like, it literally was debilitating.
But now you're wonderful. Like, you're super confident, and it's just, you just have to push through that pain in everything that you do in life.
Usually, like, I find the first maybe 5 times you do something, it's very intimidating. Yeah. And then the 6th time, you're like, oh, it's kind of not that bad. Like, you still get nervous, but that nerve is, like, kind of synonymous with excitement.
Yeah, it's more controllable.
Yeah, controllable, right? So, that's really good.
I did that, but I didn't find... I think towards the end, I didn't see it as, like, a long-term career, so I went back to university. I figured I should probably get a degree. It's kind of expected today.
Yeah,
and
it's interesting that it's a necessity, right? It's almost a prerequisite to get in front of anyone. Yeah. So I applied for these internships, and the first time around I didn't get anything. And so I went and sought out a mentor who worked in investment banking, and he looked at my CV. He's like, your CV is all the wrong format. Put it in this other format from this website called Mergers and Inquisitions or something. So this is very brutal?
Yeah, well, he great feedback. He's like, Bankify your resume. Also, don't write that you took that you deferred to work as a salesperson. He said you should rephrase that because deferring sounds like you couldn't handle uni. I'm like, that's such a sad framing because like I actually did something really great. But okay, I'll change the framing of what I did. And he was right, and so suddenly I got heaps of interviews, and got this opportunity at JP Morgan. So they flew me to Sydney. It was in the markets division, so like their sales and trading where they do they trade securities on behalf of all their clients. And so I remember in the interview, the final interview, they asked me who my favorite economist was, and on the spot I said Milton Friedman, which in retrospect was the perfect answer to give to an investment bank. If you know who Milton Friedman is, like free market economist. Sure. So I don't actually know if I would say that now, but it was just the first thing that came to my mind. And they actually called me back 15 minutes after the meeting and said that I had the internship. So I was like, that's impressive. I'm so happy. Yeah. It felt really good at the time because I knew how competitive those things were. And it was a good experience. But it was not a good fit for me. And so,
Sure.
like, they flew you to Sydney, got to stay there for 2.5 months and, like, shadow all the salespeople and traders. And they had, like,
amazing.
these morning meetings at 7 a.m. before the market opened where they discussed everything that happened. Like, it was very interesting. But I felt like you didn't really have much of an impact. And I think my interests weren't exactly in the job that they were looking to hire for. And so I spent most of my time on the computer reading, like, JP Morgan has this amazing research team, like they're globally renowned for it. And there's this rock star analyst now, he's now the head of quantitative research, named Marko Kolanovic, who has weirdly been able to predict all these things. He's a theoretical physicist turned finance guy. And I was fascinated, and I was just reading all this stuff, and they're like, what are you doing? Can you do a job?
You're curious, right?
I got a bit lost in
it's
it.
Part of your personality.
I think it was just not a good fit for me. So they actually didn't offer me a job at the end of that as well, which at the time I was like, oh my God, my world's falling apart. Like, you know how rejection feels. It feels terrible, especially after 2.5 months, because you take it very personally, right?
Absolutely.
But it was actually right, because I didn't want that job. I was more frustrated about just being rejected from something. So
there's almost a position there where you need to experience that feeling. Yeah. Because if you're just always up, you're just going to get burnt somewhere else, right? Like, something's going to happen to you, because you're always just like, your ego will almost get in your way of your success.
Exactly. Yeah. And I ended up getting an offer to do the same job at another bank anyway, but I think the experience told me that I said no to that, because I realised that's not what I wanted to do. Yeah. So it was a good lesson in that sense. Very
interesting. So what do you think the biggest takeaway was in terms of value from that experience? It's a hard question.
Do you know what a derivative is? A derivative contract? So for those of you who don't know, a derivative is a type of, like, financial instrument that derives its value from another asset, which is also a confusing explanation. So basically, like, the simplest ones that people know about are like call and put options. Yeah. So the option to buy or sell, say, a stock. And so if you pay for a call option, say you want to buy a call option on Facebook to buy it at like X dollars, which might be above the price that it is now, but you believe that the price is going to go up heaps in the next 6 months. Yeah. So if it does, then you can suddenly buy at a price lower than the price, and so you make that profit. Yeah. Or if it doesn't, then the only amount that you lose is that the premium that you paid for the option. Yeah. So, but I feel like what I took from it is because I saw how they created, there's all these more complex types of derivatives, how they created all these things, and what companies and financial institutions use derivatives for is to hedge their risk, so to reduce the risk of all their own financial positions. Yeah. But I couldn't help think that they were using derivatives to hedge their risk that was a result of the existence of derivatives, if that makes sense. Sure. So, like, you wouldn't have to hedge the risk if the derivatives didn't exist, because they increase financial market risk exponentially. Yeah, right. So the whole GFC was caused by derivatives, right? Yeah, yeah. So, but you wouldn't have to protect against that if they didn't exist. So it's just, I was just like, wow, this is concepts. A bit of a casino. That's kind of what I came away. Yeah. They always price their derivatives at a price where they believe they'll never lose as well. So it's almost like when you're buying it, you're not necessarily buying it to make money. Like, you're buying it to lose money, and it doesn't make sense to me. Sure. But
I mean, good insight, right? It's like insider perspective. Yeah. You just wouldn't see it unless you were there.
Yeah, exactly.
That's fascinating. All right, so I like to like transition when we do podcasts into like different sections. So the first part was obviously about your experiences. The next part's kind of about you being an investor yourself. And then looking into like kind of the mindset of a VC, right? So tell us a little bit about the company you work for, BlackBird.
Yep. So BlackBird is a technology-focused VC in Australia and New Zealand. So we've been investing since 2012. The founders are Nikki Shivak and Rick Baker. So that first fund, they really had to hustle to raise. It was a pretty low point in Aussie VC. And I think it was 29 million, so much smaller. but they actually invested in Canva in that fund. So that was a massive success. And in VC, basically, once you get a few successes, like you kind of get the right, or you earn the right to keep raising funds and keep investing. And since then, like they've had a number of other software successes. So things like Safety Culture and Culture Amp are pretty well known. Dovetail is emerging as a superstar at the moment. But whilst BlackBird is very well known for its software investments, you know, we have consistently invested in a lot of deep tech and frontier technologies as well. But I think they take a lot longer to mature, so people don't know as much about them. But they are beginning to, which is really exciting. And so those range from like quantum computing to space tech. So we've got Gilmore Space, Fleet Space, which is doing really well at the moment, and then some really interesting life science things. So Inventia Life Science, who are doing 3D cell culture, or Cortical Labs, who recently trained neurons to play Pong in a dish, which is fascinating. So
how does that? Yeah, that's quite unique.
It is. So it's like natural reinforcement learning, which I guess is how we all learn. So it's really interesting.
Yeah, absolutely.
So yeah, broad-based venture capital firm, stage agnostic as well, so anything from pre-seed to like Series D. The idea is that we want to invest in, this is our tagline, wild hearts with the wildest ideas right at the beginning. So the dream for us is we meet someone at the pre-seed stage and we follow them all the way out to their late stage until they kind of become public or whatever their final outcome is.
So I have a question just about, like, you know, considering how a VC would delegate money. It's all right. Some people like to tap. It's all right. We've just tried to avoid it.
I realised I'm doing it.
No,
Sorry.
It's okay. It's not that bad. But yeah, so when venture capitalists invest funds in a startup, is there a calculated, I guess, risk of error in terms of, you know, them putting money into a startup, you know, and then knowing that a certain percentage of them are probably likely to fail? Is that ever a thing that you consider?
I'd like, to be honest, the actual number doesn't come up in discussion, but it's kind of known that this is, so venture capital on the risk spectrum is like the highest risk investment asset class. And it goes like venture capital, then like traditional private equity, and then you go into like risky debt and all that kind of stuff, and then equities and like fixed income, right? So there's like that spectrum. I probably missed so many things there.
No, that's okay.
So, you know, you're right, they do expect a certain loss rate, and at the moment we're investing out of two funds. So we just announced our raise of $1 billion Aussie dollar fund.
That.
So that's split across.
Like unheard of in Australian
Well,
VC,
it's the record, so it's the biggest fund, and it's a great sign for the maturity of the Australian ecosystem. So we were all so proud of that. And where the fund is split into two funds. So you have the core fund, which is 300 million, and that's for pre-seed to Series A. And then the follow-on fund, which is 700 million, and that's like Series B plus. And they have different risk profiles. So in the core fund, basically what we want to believe with every investment is that it has the potential to return the whole fund. Whereas the follow-on fund has a different kind of mandate, and it's more about absolute returns. So, you know, you have a lower loss rate. You don't expect, when something's at Series B, you don't expect it to go to zero as often as you do in like pre-seed. But I guess it's kind of like a little bit lower risk return in the follow-on than it is in the seed. But the seed has, in the core fund, but that fund has more of like the power law outcomes embedded into it. So, you know, if you put random numbers on it, like you might expect like 30% to go to zero, like 40 or 50% to kind of return themselves, and then like, the remaining 20% might be power law outcomes and pay off the whole fund. Yeah,
interesting. So how do you determine which, I guess, fund a startup really belongs to? Is it just based on maturity?
Just based on their stage.
Based on maturity. Okay, that's interesting. So in terms of, I mean, I went to a I think it was like a accelerator launch the other day called Translating Research in Melbourne. They had like a display, right?
Tramaganza.
Tramaganza or something. It was very unique, and they had really good ideas. These two men, they spoke about their experiences in the startup world, and they had an interesting perspective. I forget their names, I'm sorry, but essentially they were talking about, a lot of people have this perspective in the Australian market that if we want money, we need to go to the US, right? But now you're sitting here telling me that there's BlackBird's breaking records with VC investments and things like that. So what's your perspective in terms of opportunity to raise capital in the US versus Australia? Maybe how that will change, you think, over the next X amount of years?
Well, I guess BlackBird was started with on the belief that Australia can build globally successful tech companies. And we've seen that. So we've got Atlassian and obviously Canva and a number of others now that have been really successful. And so now that local founders have that example that they can be successful, and they can build from Australia, the evidence is there that you can raise locally. Another thing is, venture capital is very much a relationships industry. So it's about who you're connected to and who you can get, an introduction to. And of course, you can always do a cold reach out. That's totally fine. And I've done that plenty of times in my life for things. So encourage people to do that. But if you go to these events, you meet people and you get tied in with the local VCs. If you want to do that in the US, it's like you have to think about how you're going to build up that network.
Sure.
So
you think like the barrier to entry is higher?
I would say so. I mean, BlackBird still has a pretty, high bar. So we'll probably see maybe 3,000 companies a year. And I think we're going to make around 20 investments this year.
Okay.
So it's high.
Yeah.
But the benefit of having an Aussie VC and you're building in Australia is also just you're there together and we can help you, right?
Yeah. It's always better to have people, there in front of you as well. Having those business meetings with people who are actually there, not overseas somewhere, right? Yeah, for sure. So BlackBird, they had this prediction, I can't remember where I read it, but they reckon that by 2032, I guess the tech industry in Australia will make up 20% of Australia's GDP. It's currently sitting at around 8%. Yeah. What are your thoughts about that prediction?
I think it needs to happen because Australia...
I mean, especially with the way that the economy is kind of drifting probably downwards at the moment.
Yeah.
That would probably, help, I guess, reinvent the economy in itself in a new sector.
I think Australia needs to do it because, as people know, we have been overly reliant on mining and natural resources. So that is a structurally declining industry.
Yeah.
We're decarbonising, so the demand for that has an end point, right?
Yeah.
So the government knows that we need to transform our economy, and tech is the perfect sort of sector because it can bring along all of our generation with it. Like if we start now, we're all, we've grown up with technology. So it's the right time to move that transition, and I think they are putting effort into that, but it's also up to us as well.
Yeah, of course. Yeah. I mean, having conversations like this is definitely one of the ways we can start this, right? Like getting people more involved and interested in the whole sector itself. So it's a good thing that we're all doing. Now, you touched on, pre-seed, seeding, Series A to, D. Maybe let's talk a little bit about that process and exactly what those particular areas of funding are or raising capital are. So maybe you can share some insight about the process of actually raising capital. So if let's say that I'm a very rudimentary startup and I'm looking at raising, my first amount of capital, what's the best way to approach that? And how does that change over the course of my business?
I think you have to think about the type of company that you're starting and then sort of back solve from that as to what you will need to prove. And so my thinking around this, and it's definitely not everyone, so totally saying this is an opinion, is that the amount of for like customer traction that you need to prove is also a function of the type of business that you're building. Yeah. So if you're building something in deep tech, right, you're not going to be able to show that you have revenue because you haven't even proved that technology works, but you might be an expert in X field and you've collaborated with someone who's really good on the business side and you want to develop that. And so if you can tell a really good story about why this is such an important problem, then maybe, you can come to us before you have any revenue or customer traction. At least you have evidence that this is a problem that people need solved and that you have a way to do it. Yeah. Whereas if you're building something like an app or software, what I've noticed is that the investments that we make in those areas tend to have a little bit more traction. They have an MVP built or they have some initial customers, evidence of customer love. It's a lot
easier to reach out to potential first users, right?
Yeah.
You can almost just use people that you know and say, try out my MVP, see what you think.
And there's less barriers to actually produce that first prototype, right? You need a computer and start writing code.
Exactly.
Whereas how do you do, a quantum startup without money?
It's very difficult.
So it's that's my view and how I'm thinking about it, but also it evolves. So I think, it's always good to engage as early as possible and get feedback and to on how you can sort of iterate on your story. But the first thing that you want to make sure of is that you're solving a real problem and that you're solving it in a unique way.
Yeah. I mean, people always fall into that trap, right? Becoming a startup founder for the sake of it.
Yeah.
Rather than actually solving a problem that has a demand.
Yeah, or like solution in search of a problem type thing.
Yeah. So, I mean, like, it's a rarity for that to work. It can work, but it's unlikely, right?
Yeah.
The more traditional way is to find the problem and then find a solution for the problem, right?
Yeah, and then your story becomes much more compelling as well.
Yeah, of course, right? Because it makes sense in a general pitch when you're actually introducing the idea. You always want to start with why this is necessary, and to do that you need to highlight the problem. If there's no problem and you need to explain your solution to define your problem, it's like, okay, where are we going with this idea? Like, is this just something you want to do for the sake of it?
Yeah, or it might just be a regular like lifestyle business as well, because how is that going to turn into a multi-billion-dollar business if there's 20 other people doing it?
Yeah, because I mean, there is that distinct difference, right? Like something like what we're doing. So we have a software development company. It's very much a lifestyle business because it's a service, right? We're not going to be scaling up billions of dollars like Snapchat or something like huge app like that, right? But then there's those really fast growing companies that, they get almost raise capital very early on and then they just expand rapidly.
Yeah.
Right? So there is a distinction there. Okay, so in terms of, a venture capitalist versus something like an angel investor, what do you think well, I mean, you obviously know, but the differences between those two things and which one is right for what type of business?
I only have like a pretty basic understanding of angel investors, I will admit. I think the thing that you need to understand about VC when you're going for VC investments is the return requirements of the investor. Yeah. So VC, we have a $300 million fund for our core fund. If you're coming in at pre-seed to Series A, we need to believe that our investment in your company could potentially be worth $300 million in, say, 10-ish years at the end of our fund cycle. So, say we buy 15%, it gets like diluted down, then you divide, that 300 million by the percentage to see what the valuation of the company needs to be. So say, even if we end up with 10%, 300 million divided by 10%, it's 3 billion, right? So if your company needs to be worth $3 billion, then you need to look at, comp multiples in the market and see what those kinds of companies have been valued at now and historically, right? Because it's not like we're in a low point in the market, you should probably take the average between the high and the low and say, hey, we're going to be like 5 times ARR to be, and then you're like, okay, so 5 times, what does that fit into 3 billion? Yeah. What's that? Like 600 million? Yeah. Or more?
I think it's more,
Yeah. So, that's the threshold with a VC. Yeah. Versus an angel investor, they don't have a fund that they're investing out of, right? They're probably thinking more in absolute returns. Like,
so like I give you money and you give me money back.
Yeah, like if I give you money, can you 10x it or something like that? Which is probably more reasonable because the power law outcomes in VC are more than 10x. They're usually like 100x or 1000x. Oh wow, yeah. So the good thing...
I didn't know that. I didn't know that the expected return for VC investing is so high.
Yeah, it's all about...
I guess it's all about the risk, right, as well. So
it's all about the power law distribution. It's all based on that. So the idea that you maybe get 2 winners out of a fund and then you back solve and you're like, okay, if we need to meet our hurdle requirement, that's what we need to do. So I think that's a really good thing for founders to understand when they're pitching and to sell that story of how you become that outcome. And that's totally the long-term vision, right? You need to have the intermediary steps as well, but we want to see that that's your goal. Versus angels, sometimes if it's not immediately obvious that outcome is possible, angels are more willing to enter. I'd say they have an even higher risk tolerance, and to support those like really foundational companies to sort of get them sometimes from that like pre-seed to seed point. Sure. And so there are a lot of companies that first do an angel round and then have been successful in raising VC after that. Yeah. So
okay, so you can do both, but it
depends
on the company.
Often angels invest in rounds with VCs as well.
Okay.
So
so they make up some of the
hybrid. Yeah.
Okay. I mean, they'd probably invest, like in terms of capital being invested by a VC or an angel investor, I'd say would it be accurate to say that a VC would probably have more money to invest? I guess that would depend, right? But on average.
Yeah, that's true.
Yeah, so most of the capital would come from a VC, right?
Yeah, angels will generally give you smaller checks.
Sure.
if you want to do multi-million-dollar rounds, I mean, there are some really successful angels who are past founders and they do that kind of thing. But
well,
for the
like
most
Shark
part,
Tank, right? Like
yeah, exactly. For the most part,
I mean, they invest in a lot of companies that don't go anywhere as well, but it's all part of the risk.
Yeah, right? Exactly.
Yeah. Okay. So I have a question in terms of VCs themselves. How do they actually get funding for the companies they're investing in?
Yeah, so in the early stages, so with BlackBird's first fund, the majority of that didn't come from what's called like institutional investors, so your super funds and your investment funds, asset managers. It came from like high net wealth individuals and people that they knew, and like ex-founders who wanted to put in like, kind of pay it forward and put their returns back into the startup ecosystem. And that's because, to get investment from institutional investors, you need to have a track record and you need to earn trust.
Yeah.
Because they're also managing other people's money, right?
Sure.
So, but BlackBird did really well, and then and so have a number of other VCs in the local ecosystem, and that's earned them the right to get funding from the super funds. So the majority of our funds do come from super funds, and also the Future Fund, which is Australia's sovereign wealth fund. And so I personally see that as really great, because I actually worked as a grad at Australian Super previously, and I know how much money they have, and I feel like this is the perfect alignment of incentives as well, because super funds are investing our retirement income, right? Yeah. We're in our 20s, so we have that beautiful long-term outlook, and we can weather those kinds of ups and downs, and so it's a really good return profile for them. And to us it feels like a lot of money, but to them it's really not.
Yeah.
So
sure.
They just have to be, you have to prove trust, and now that we have that, it's a great source of funding for the ecosystem. And I feel like that will feed into what you said about the economy maybe being made up of 20% tech. Did you say by 2030?
Yeah, by 30 something.
So that will also be funded by our retirement incomes. Like we have this, it's really unique in Australia, really. So Australia has the 4th largest superannuation pool in the world, which is crazy because we're like 25 million, is 26 million people now.
Something like that,
It's hugely disproportionate. So we should be putting this money into our own economy, right?
Yeah, sure. All right, so let's say that, I've just raised capital from a VC, for example.
Yeah.
As a founder, right, how do I determine where the money should go? Like, what's a good user case of how I should spend this money to grow my business as fast as possible?
Could you say that again?
Yeah, so for example, you're a VC, I'm a business owner.
Yeah.
You'd probably have to quantify this before I actually raised capital, but what's the best way for me to spend my money to get the best returns as a founder of a company?
I think it's pretty context specific. So ideally you want to run lean. You don't want to be like just spending money everywhere, so you want to be careful. Generally when you do a raise, when you get to the later stages, we're going to ask for a breakdown of what you plan to spend the money on. So when you're choosing how much to raise, you should think about what milestones do you want to achieve, and then what do you need to achieve them. And generally in the early stages it's mostly just labor, right? The thing with software businesses is that they scale really beautifully, so you don't just need to keep hiring people infinitely. Like, your marginal return should improve once you get to scale.
Sure.
But with more labor-intensive industries like deep tech, you're just going to keep needing people until the product kind of works. So I think with where you spend the money on is always a function of like what you want to achieve. And there's also an art to working out those milestones. And so, if you're raising a pre-seed, you have to think about, what do I need to prove to earn the right to raise a seed round? What do I need to prove to earn the right to raise a Series A?
Yeah.
And so you can also set those out with us, and often they're not right on the first time. Like, we can give you feedback on what we think would actually, from a VC's perspective, for this particular business, will actually unlock the next round of funding. But it's important that you at least think of it that way, and that helps you understand how much you need to raise.
Sure.
Yeah. So, sorry, a bit of a
no, that's okay.
Fluffy answer.
It's a bit of a fluffy question. So previously we spoke with a girl. She's very talented. Her name's Cara Davies. She's the founder of Step In, which is a fitness app.
Yeah.
Who said that most of the money raised generally goes to salaries, right? Like, because labor is expensive. So a lot of startups and people who are creating businesses they'll outsource to reduce their costs, meaning they go overseas to get developers, whatever it may be. What do you think some of the risks associated with going completely offshore are?
One thing that we say at BlackBird is, if you don't have the technical talent in-house, sometimes you don't have that sort of like product DNA in the business.
Yeah.
And so there are success stories of where people have outsourced the tech, but generally, if you look at all the successes in Australia, they started with in-house engineers building out the product.
Yeah.
And also, you have to think about alignment with the mission. If you're outsourcing to someone and giving them no equity, why are they going to care about the outcome? Whereas if you're incentivized internally, like you have shares or you're a founder, then you want the outcome as much as the VC does, right? Sure. So it's about that incentive alignment.
Yeah.
And it just tends to produce better companies.
Sure.
Yeah.
But I mean, as you do scale, there probably is a utility for using, I guess, overseas resources to complement the company that you've kind of created, right?
I think at the early stages, like for some people, it's just not possible. Like they don't have money and they want to build something and they outsource. But as you scale, it almost, like, I'm sure there's exceptions, it comes in-house.
Yeah.
So all the big tech companies in the world have all their product in-house.
Yeah, sure.
So,
Interesting. So, in terms of a VC delegating or delineating the funds around, do they consider the founder's age at all in terms of, how much capital or whether or not they take the business seriously? So, you get a lot of companies coming out of the university accelerator programs potentially, and they need funds to grow their business, versus someone who is a mature, experienced, business owner who has now gone off a venture and asks for funding for his business.
Yeah.
So is there a different perspective of the way that companies look at those?
I think it's not obviously said, but when someone is young and has achieved a lot, it's very impressive, right? But when they're old and have achieved a lot, can be kind of expected.
Yeah, sure.
So it's you come across as more impressive if you're doing all these things and you're quite young. So interestingly, I read a paper recently which the view in VC is actually that they prefer to fund young founders. Like, this is not BlackBird in particular, this is like VC in the world, right, as we see. And I think it's because there's an element, and this is definitely something someone else has said, I just can't remember who it was, but it's that element of naivety that kind of sets you up for overcoming really big problems and difficulties in the startup path, because building a startup is hard and unpredictable. And if you were not naive and you knew that from the start, you almost wouldn't do it. So because of the naivety that's inherent in young people, I think
they're almost willing to take more risk, not knowing what's ahead of them, right?
But weirdly enough, this study actually said that on average the most successful tech exits are from people who started companies in their 40s or something like that. But
maybe they just understand the business world better.
I was speaking to someone recently and we were thinking about all the things that they didn't cover in the study, and that it's not perfect, but I actually think VC is biased to young founders, and maybe we should widen the net a little bit given the evidence that people with experience also build really great companies.
Why do you think there's that bias? What makes you say
I think it's just the wonder of like a brilliant young person doing amazing things, right?
Like the next,
and that infinite energy. They have no responsibilities, like they're going to be fully committed.
Commitment's a thing, right? I guess older people have more responsibilities, generally speaking, depending on where they are in life. Yeah,
but we definitely have older founders in our portfolio too. Like it's not, I'm open to everything. So.
Interesting. So I guess the final part of the podcast is just about like pitching and connecting and networking, things like that. So on, I think it's BlackBird's website, they highlight the importance of pitching to raise capital and having a really solid pitch when you're asking for capital raising. What are some of the secret formulas as such of like creating a really epitome of a pitch?
This is said over and over again, but the key is storytelling and working out how to make your pitch really compelling, and how do you draw someone in with a hook. And so I think the best pitches I've seen have been ones where people don't bring up the deck straight away, like they just talk to you and you're crazily engaged, and then they either do or don't bring up some background information about the company. But it's always about really practicing the ability to engage people through a story, and something that's surprising maybe or not expected.
Yeah.
And I think they're the best pitches that I've seen. And the thing about this is that it's totally learnable. It's practicable, right?
Yeah, absolutely, yeah. You
got
to sit there, write the pitch, iterate it, and just practice.
Exactly.
The execution is important.
Bring energy to it, look excited about what you're doing. It seems obvious, but I can't tell you the number of people who I meet with who are just like so monotone.
I've participated in, many pitch competitions this year and previous years, and some people, they just rock up and it might just be their personality, they're not necessarily extroverted, so they get there on the day and they're a bit more closed off, whereas some people who thrive in those environments are very oh yeah, let's get it,
they're also excited. Nervous
everybody's
right?
Nervous,
so I understand that, and it's for those people it's just a matter of practice. You can absolutely do it. You just need to put yourself out there and be like, hey, this is not something I'm going to do the night before, this is something I'm going to work on for 6 months, and I'm going to smash it.
Exactly. So a pitch, depending on where you're doing it, would probably typically go for 2 to 5 minutes, unless you're raising more capital, right?
Well, a pitch to BlackBird is probably, if you're meeting our partners, it's more of an hour.
I'd say an hour or something.
So usually it starts with you telling us about the story, the company, and whether you want to rely on slides or other media formats.
Sure.
You do that then, and then it turns into a discussion.
Yeah. So let's say you were pitching to the community to kind of engage them in the idea, show them, showcase a competition, right? 5-10 minutes or something. I feel like some people, they start the pitch, and there's nothing wrong with it. It's just a way that you can start a pitch is that emotive attachment. So they start with some sad story or something like that. Now, I always found it hard with such small amount of time to engage people emotionally. What's your perspective on pitches that start with that emotive capture?
I think...
Do you think it's a good thing or a bad thing, or do you think it can work, or to avoid it?
Oh, I'm going to give you a boring answer, but I think it depends on context, right? So there are some pitches, there are some companies where that's totally true. The founder has been through a really difficult experience, and it's really important to tell that story, and that sort of lends credibility to their mission as well. In other cases, you don't want to tell a sad story if it's not true, or if you're exaggerating.
You don't want to lie,
Yeah. So it can be anything. If it's necessary, if it's actually a key part of your story, then I think you should tell it.
Sure. Yeah, leverage it.
And it will come across authentically, right?
I guess that's probably the most important part, is that if you go down that emotional pathway, that it comes across as you having humility and actually being honest and true about it, right? Genuine. So I guess you would have seen, dozens of pitches across your time as an investor, just throughout your career. What do you think some of the traits are of what make a pitch memorable?
The most memorable ones have been people who have started without decks, I find, and when they just go into the story,
just talking to the crowd.
And they're just very good at it. And I mean, maybe that's not in the pitch competition, because in a pitch competition everyone always has slides. I'm thinking more about when people pitch to me. So if you were in a room with someone and a couple of your partners or something, if they start by actually talking to you about who they are, type of thing, and then engaging in that storytelling, and then leading into the pitch, it's smooth, right? It would come across a lot more smooth than just being all right, I'm going to start now. Let's go. I definitely just remember the people who bring a lot of energy to it, because it just it conveys their passion for what they're doing, and it should be easy to be energetic about something that you love. So it's very much an anti-signal if you're not, right?
Yeah, sure.
So,
no, that's good. And then of course, pitfalls that founders make when pitching.
Yeah. So one thing that stands out to me, and I think it's just a function of when you look online how to do a pitch deck, they say, put the numbers in, what's the TAM, what's the SOM.
Sure.
But that kind of stuff is it's rubbish in, rubbish out, right? How can you... most of the time those predictions are wrong, and if you should be able to... The opportunity should be obvious from the story that you're telling. I don't think you need to tell us how much your predicted dollar value of the market is, and then if you're going to capture like 10% of that, you could be rich. Like we know that. So
how do you highlight that then in a way that isn't just, statistical? Like,
have you watched the Figma pitch? So I saw that somewhere on Twitter, and that was, he didn't use any numbers. It was just like it was actually a terrible pitch deck, like design wise. You think he was just like it kind of had an element of humor to it as well, and they're memorable as well when there's something like funny about it. Like there's been quite a few AI pitches where they bring up the like Apple that says iPod and the classifier says it's an iPod or something,
Okay,
But you kind of like, you soften people up and get a bit of a laugh out of them. So I understand, like, it's easy to just rely on the typical pitch deck, and you probably won't, it's not the wrong thing to do, but it won't make you stand out.
Sure.
So just think a little bit more about it. It's always about critical thinking. How can I be creative? How can I show that I'm creative?
Yeah.
Because you're going to need, that's a critical skill.
For sure. Yeah. I mean, in the pitch competition, I competed with your partner against your partner. That wasn't raising capital or anything. It was just a bit of fun with the university, but we had to describe our research projects to a lay audience. I don't know if Jackson told you about what I did.
He probably did, but I forgot it.
That's fine. So I thought to myself, like, everybody's just going to be very like, how do I really reduce, the effort for someone to understand my research project? And it would still be very like structured and like things like that. So I actually just threw it on its head, and I was like, what's something that no one else will do that will just make me stand out? So when the judges are there, they'll be like, oh, well, I'm going to remember this guy because that was interesting.
Exactly.
And what I did was, because I'm a cancer biologist, I explained the pathology of cancer using an analogy of the mafia, right? So I had, the big mafia boss, he was the tumor. And then I had the little cancer cells who were like the little mafiosos, the little, I guess, henchmen of the cancer. Had the police who, bat a blind eye sometimes, being the immune cells that sometimes allow for cancer to propagate. And then when I was explaining it, I put on a persona of like a, typical New York gangster, right? Put on the accent and then engaged the crowd, and then went back to like, the scientific, okay, let me break that down for you. And it worked really well just because it was like, oh, this is different, right? Everybody was like, this is different. I'm engaged, right? Even though I was the last one presenting, everyone was asleep, and then they all woke up when I started to present. So sometimes, I mean, probably raising capital, you don't want to put on an accent. It could probably come across cheesy or something, but at the same time, there are things that I feel like you can do especially a pitch competition that can, make you stand out as a presenter.
Well, it just shows that you've really thought about it. You really want to win, and you're trying to think about how to stand out in the first place. Like it says a lot about the person in a sort of unwritten way.
Absolutely.
Are you actually trying? Are you putting effort into this? So that's so cool.
Absolutely. So look, we'll wrap up the podcast, but before we wrap up the podcast, what I'd like to do is I'd like to just ask you, is there one last piece of advice that you want to kind of have tabulated here for the entrepreneurs looking to raise capital, right? Or just a piece of advice in general for the founders out there watching this episode?
Be different.
Be different.
Yeah.
You want to elaborate at all?
You want to stand out. It's exactly what you said, right? If you just like get advice from people and do exactly what they say and do exactly what everyone else has done, you're going to be exactly what you expect, which is not very memorable. Exactly. Yeah, there you go. So you got to stand out, be memorable. Very good advice, very good perspective. We appreciate you coming on this episode of the podcast. And I'm sure that it was very insightful for all the people watching out there. So thank you so much for coming on the podcast. Thank you for having me. That's all right. Thanks a lot. No worries. So hope you liked that episode of the Student Founder Podcast. If you like this episode, make sure to like and subscribe to all socials. They'll be in the description. I just want to reiterate again, this episode was brought to you by my company, Rofi Labs, a software development startup that helps get startups and tech off the ground. So please reach out to us if you want to have a chat, and we can just talk about how we can help you out as a company. Thank you so much for tuning in, and we'll see you in the next episode. Take care, everyone.